Hey everyone, it's Al Labaroa for Financial Intelligence Training. It's Saturday, it's September 26th, and it's 2020. We're back with another short update on the markets. Here we are 4 weeks into the month, rounding the turn into the end of the quarter. I've said it before, and I'm going to say it again. September and October are the two wackiest months of the year. Now, on a personal note, some of you may not know this, but I'm a coach. I have coached youth sports for years, and as a coach, you will inevitably find yourself at times behind in the fourth quarter. To me, this is an opportunity to teach the kids to shine. It's here that we find ourselves. And what I try to instill in the kids is that the outcome may not be 100% in our control, but our effort certainly is. And it's at those times that we must reach within, find the strength and the determination to give it our all. We must finish strong. And that's exactly what the stock markets did yesterday. They gave it their all. The Dow rose 1.34%. The S&P climbed 1.6%. The Russell jumped 1.59%. And the NASDAQ soared 2.34%. But much like my Miami Heat did last night, they ended the week on a sour note, ending in the red. For the markets, it was the fourth straight week of losses. But what should be noted to all of you market watchers out there is that last week we witnessed what I believe is the third highest outflow of dollars fleeing from stocks. Over $25 billion took their ball and went home. Now, many a traditional Wall Street portfolio is built upon a strategic asset allocation, one that consists of some part equities and some part fixed income. The percentages of those portfolios are mostly determined by one's risk questionnaire, not the markets, not the economic environment, the risk questionnaire, meaning how you answer those questions determines how you're positioned in the market. So, 4 straight weeks of losses, or 4 straight months of losses, or 4 straight years of losses would make no difference on how you change your allocations. That's just mind-boggling to me. The common thought is that, well, all will be just fine. And while it might be, that dynamic changes dramatically when one uses a portfolio to live off of. As soon as money starts coming out of the portfolio on a consistent basis, the return profile no longer looks the same, regardless of the market conditions, good or bad. But bad becomes worse and could unfortunately become treacherous. That's why, in my opinion, risk management becomes far more important than relying on the traditional structure of just asset allocation alone to protect you. I'm a firm believer that it is impossible to diversify away systemic market risk through asset allocation alone. Let's see what that looks like for a moment. We know how the equity markets fared this past week, but how about fixed income? Has it been spared the pain felt by equities? Well, according to Bloomberg data, the year-to-date 2020 high-yield issues bested $330 billion this week. That's a number that we haven't seen in an entire year, nonetheless 9 months. And to see that number, we'd have to drop back to 2012. Keep in mind, we're not even in Q4 yet. Now the question becomes, is this pace sustainable? The answer is only if the investor risk appetite remains. So to gauge this, let's look at credit spreads. Yields are now at a 10-week high, and with over $4 billion in outflows there last week, that means things are changing. It's no wonder the government is quietly buying up the debt of major companies. I mean, shockingly, it's public knowledge, but most are unaware of that fact. Yeah, the government is buying the debt of companies like Apple, Microsoft, Amazon. Seriously. So for those interested in an entire list of what the Fed is buying, or if you need some reading material to help you fall asleep, you can go to the newyorkfed.org site and search the composition of the secondary market corporate credit facility. But be forewarned, what you read may actually have the opposite effect and keep you up at night. All right, guys, kidding aside, markets are in a really very precarious spot here, with the major indices continuing to live under their respective 50-day moving averages. In fact, the Russell, it's flirting with its 200-day moving average. Last week, I mentioned about the leaks in the dam and the need for those leaks to repair themselves. Well, this past week's price action did not help that cause at all. And now we're 38 days away from the election, and I'm not even sure we're going to have a known outcome, but the clock is ticking. Interestingly, one analyst noted earlier this year that in the 90 days preceding the election, as the market goes, the election goes, meaning markets have predicted the winner 87% of the time. Now, this is not a political statement, but if you've got dollars in the market and you care about the value of those dollars, well, then I suggest you gauge your risk, that you have a plan in place to manage that risk, and that you think about how you'll weather any potential storm in your portfolio. Things are certainly getting exciting, so stay tuned, everyone. I'm Al Abaroa. This is Financial Intelligence Training. Thanks for watching, everyone. Have a great day.